Meantime, earnings season kicks off this week, as you know, and our next guest says earnings revisions suggest the profit outlook has stabilized. Goldman Sachs chief U.S. equity strategist David Kostin, with his target of 4,500, is here at Post 9. David, it's good to have you back.
Carl, nice to see you.
Are you looking forward to earnings season? Is it in a good way?
Well, we saw Pepsi this morning, so it was a good augur for the upcoming season. The idea of expectations coming in for the quarter actually have been the best we've seen since the fourth quarter of last year, meaning as you were coming into the first and coming into the second quarter, you saw analysts cutting estimates pretty significantly as the quarter earnings season reporting dates began to creep up. Here we've not seen that, and actually earnings have been pretty resilient. So I think that's a positive development, number one. And number two, this is the first time we've seen expectations that are not year-over-year decline in earnings. So that's both the revisions as well as the year-over-year change. So we're looking for basically around flat earnings for the year, year-over-year from the third quarter versus a year ago. Margins declining slightly, sales up. Sales up 2%, margins down a little bit, and you basically have no earnings growth. But if we take out energy, then you've got earnings that are going to be up low single digits. So that's a generally positive story. Remember, for the first time in a year, we're really going to see positive EPS growth.
There's been such concentration, though, in the S&P 500, and I know you note in your note that that could pose a risk to the aggregate index just because consensus has the 7 largest names contributing even more to S&P earnings in 2025, even than they do today, and it's still such a large proportion. So what might it mean if there is a miss at one of the 7 largest tech names for just the overall sentiment, the overall index?
Well, it's a big issue. We've talked about this a while, which is basically about 75% of the index is comprised of 493 stocks. The other quarter of the index is basically seven stocks or so. And so that bifurcation between the median company and the overall index is pretty significant. I think you can see that really clearly this quarter. In aggregate, you'll basically have no earnings growth, but if you took the median stocks, probably up around 2%. The expectations coming in for those largest companies are actually pretty optimistic as it kind of rolls out. We won't see some of them until the early couple days of November, so you still have another month to go. This week, it's all about the end of the week. Of course, the financial stocks will be reporting, and I think the narrative and the thought process in our discussions with portfolio managers tends to be around higher for longer, which companies have strongest balance sheets and more particularly less exposure to higher interest expense. That's really, I think, an aspect of portfolio management that's really driving a lot of conversations right now.
Yeah, David, in terms of the rate impact, I know there's a lot of focus on, margin, influence there. In other words, if you're a net debtor and what the interest costs are going to do next year, this general sense of margins can't stay up here, can they? I mean, that seems to be that sort of gut reaction that people have, labor costs going up in some areas. But then you also have these huge growth stocks, massively profitable, that have a huge influence on the index. So where's really the trend of margins going into next year?
The margins at best are flat.
Okay.
That's the best story. The best I can offer you is a flat story. You've got higher labor costs, you have higher interest expense, you have higher energy prices in particular are going to be headwinds for a lot of companies. We're already seeing that in terms of some of the conversations that we've had with some of the companies worrying about 2024, and we recently rolled out earnings estimates for 2025. In fact, thinking out the next couple of years, you're looking this year around $224. Mike, we've been flat all year long at $224. Estimates have been coming down, sort of converging around this level. It's number one. Then you got $237 for next year. It's up around 5%, and $250 if you look all the way out into 2025. So that's the general trajectory of how earnings are going. The market probably follows along that trajectory as well. Rates are higher. More expensive. Cash is pretty attractive. All the money is going into, not all, but a lot of the money going into money market mutual funds, for example. Not really seeing big net inflows into equity so far this year.